chatting with John Gajkowski, who is the co-owner of the Money Managers Financial Group. Thanks for joining us today.
Thanks, Fritz.
So we're talking today about how not to spend your tax refund. You know, everybody's getting their tax refund now. How not to spend that. So you have a couple of pointers, and you have sort of a memory mnemonic on that.
Right. It's spend it, lend it, depend on it. What you don't want to do is not have an idea. Most people know you're going to be receiving a tax refund 6 or 8 weeks before it comes, and you have no idea what you're going to do with it. You want to have a plan, otherwise that money typically gets spent frivolously. What you also don't want to do is lend it. You just got off a situation where you made an interest-free loan to the government for the last year. Now what you don't want to do is compound that by lending the money to someone else who probably will not pay you interest and you might never see again. They might not be as creditworthy as our government. And the last is, what you don't want to do is depend on your refund. If you're depending on your refund to dig yourself out of a hole, it's kind of a symptom of long-term financial problems. So what you want to do is make sure that you know where that money's coming from. If you're getting large refunds on an annual basis, what you want to do is go to the IRS site and recalculate your withholdings so you have that money in play all the time. With that extra money on a monthly basis, what you can do is contribute to your 401k, which will increase your tax deductions, which will free up even more money for you.
So a compound interest on compound interest.
Right.
Now, thinking about the opposite. In fact, actually, that's an example of one thing to do. Give me a few more examples.
What you'd want to do for most people is, if you're in a situation where you're in debt, take a look at the high interest rate, typically credit cards, and pay those off. Come up with a strategy to pay off those debts. What you want to do is pay off the high interest rates and then go to non-deductible loans, then to your mortgage, or add to additional savings.
John,
maximize your 401k, your IRAs, things along those lines.
Sorry about that. Thank you very much for joining us today.
Thanks, Fritz.